Here we are. I want to just thank everyone again for presentations and discussions and papers. It's been great fun. We're going to wrap things up here with a panel on the term premia. I feel a certain, we've had a very broad subject. We've had a tour of centuries and the huge subjects. And now we're going to zero in and talk about the thermometer to see how the patient is doing and see if the bond market has anything to tell us. So we're going to zoom in on something very particular. We have Rich Clarida of PIMCO and of Columbia, and also a colleague of mine at the Treasury 25 years ago, James Sweeney of BlackRock, and also a colleague of mine at BlackRock. So we're all going to have fun. You have our biographies. Rich is going to talk for about 10, 12 minutes, and then James about the term premium. Then we're going to have a conversation and invite you to join us. So let me turn it over to Rich.
Well, thank you, Peter and Debbie, for inviting me to this conference. I made it this morning, and I've learned a lot. And on that topic, I should also mention, since Peter did, I had the real privilege of working with Peter. Was it 25 years ago? Wow, time flies. But if you put the dummy variable in the regression of when did those 1990s surpluses turned to deficits, September 11th, and I was in Peter's office on September 11th, 2001. So that's another story. The term premium, so much to say, so little time. So I'm going to start with some basics, and then maybe either at the end of my 12 minutes or in the conversation, maybe get a little bit more provocative. Okay, so first of all, what is the term premium? Let's define it. The term premium is just the arithmetic difference between the yield on a long maturity bond, say a 10-year bond, and the expectation of the average of short-term interest rates, say 1 year or 3-month interest rates over those 10 years. And then there's a residual, which is the term premium. So the term premium is the difference between the known yield on a long maturity asset and the expectation of the total return of rolling over a bill or a 1-year security. So importantly, in order to model the term premium, you have to measure it. And given that definition, when you're measuring the term premium, you're measuring the expected path of the short rate over the holding period of the bond. So one thing that maybe folks in this room don't forget, but a lot of folks not in this room forget, is that any term premium model is a model of the expected path of the short rate, and thus a model of what the Fed is going to do. If you think the Fed sets the expected path of short rate, or at a deeper level, if you're John Taylor, what the expected path of the economy will do, which through a Taylor-type rule feeds into the short rate, which feeds into the term premium. And so people often talk about different term premium models, but that really what they're saying is these are different models of what the Fed's going to do over the holding period of the bond. So one thing I've done in my own work and put up on the web is I try to be agnostic about models. And so I look at 4 different measures of the term premium based upon 4 different measures of the expected path of the short rate over the next 10 years. 2 are based on surveys where you ask smart people what they expect the expected path of short rates to be, and then 2 are based upon econometric models. And the good news is all 4 of those measures of the term premium more or less rise and fall together. So reassuringly, there is a common factor across term premium models. I guess I should say the models. One is the model maintained by the New York Fed, the ACM model. Another is a model maintained by the San Francisco Fed. And then there are 2 based on surveys, one based on the survey of primary dealers and market participants, and one based on the Livingston Philadelphia Fed data. So the good news is that all 4 of those measures rise and fall together. So that's reassuring. But they give very different point estimates today. So in particular, the currently estimated term premium in the 10-year Treasury curve right now. It could be as high as 150 basis points and as low as maybe 80 or 90 basis points. And so, the differences are not immaterial, but at least they rise and fall together. So next point is, so why is there a positive term premium? Well, there doesn't have to be a positive term premium. Indeed, estimated term premia in the decade before the pandemic were at best zero and oftentimes negative. Now, if you want to start modeling negative term premia, I think it's helpful to move away from the most academically elegant models and really think about things like preferred habitats, regulation, market imperfections. I'm a student of the elegant theoretical term premium models, but even their proponents would say that I think they're somewhat lacking. So as a practical matter, you do want to start thinking about things like habitats and market segmentation, and there are models that do that. Now, you can also do term premia in real or nominal space, because many countries, including the US and the UK, have inflation indexed bonds, and that leads you into an entire discussion you can have on term premia for different sorts of risk. Is it inflation risk, or is it real rate risk? I think an important development in the last 25 years that I've written about and I've thought about a lot is you can't really have a discussion about the term premium divorced from a discussion about the monetary regime, or more narrowly, the credibility of monetary policy. So one thing that's very commonly discussed in fixed income markets and investing is the fact that for most of the period from the mid-1990s until perhaps 2022, treasuries were a good hedge against business cycle risk, and that treasury yields tended to go down when the economy was in a recession, and they tended to go up when the economy was booming. And so that hedging value is one of the reasons why you might have an attenuated term premium, that people actually like an asset that does well when the stock market is down. So you have to factor that in as well. Now, I mentioned that the current estimates of term premia that I consult in the Treasury curve are somewhere in the neighborhood of 100 to 150 basis points, and they were all zero or negative, 8 years ago. So I think it's pretty clear that whatever the term premium was in 2019, it's higher now. The interesting thing, though, is that it's not higher than it was in the 1990s. And in the 1990s, debt was not 100% of GDP. It was in the 30s and falling. You might argue that, well, but perhaps central bank credibility, and if you go back to the bad old days of the 70s and the early 80s, that's probably a story. But by the mid-90s, monetary policy, I think, had credibility. And so an interesting question is, if you want to start putting numbers on the term premia, is what the given models that say it's 150 basis points now said it was even higher in the 90s with much less debt and probably comparable central bank credibility. Finally, before I maybe move into more provocative elements, certainly one thing that I have focused on in my entire career is you have to think about the global dimension of the market, global dimension in finance, in particular, the global demand and desire to hold treasuries for the usual reasons, safe asset, valuable collateral, and the like. And so that's obviously something else that you would have to factor into the discussion as well. Maybe I'll just sign off in my opening remarks, and then we can get into a lot of different things during the Q&A. Recently Secretary Bessent made some news in a piece that he published both in the Wall Street Journal and also a lengthier version in the International Economy magazine, in which he was quite critical of what he called gain of function Fed policy. And there were a lot of things about Fed policy that Secretary Bessent didn't like, but two of the things he didn't like was the very large balance sheet and the allocation of the balance sheet to mortgage-backed securities. And so maybe at some point in the conversation today, when it comes up naturally, I can talk a little bit about how to think about that in the context of the term premium too. But I'll give you a little teaser of where I'm going to land. Is the Secretary might be careful what he wishes for in that context if you talk about some of the alternatives, at least starting from this initial condition. But I think I'll leave it there, and I look forward to hearing from James and Peter. Thank you.
Thank you, Rich. And I would agree with the description we've heard of the fundamentals of the term premium. Maybe I will discuss some cruder ways people on trading floors think about the term premium, in addition to the ones he mentioned, which are widely followed on trading floors also. But then I want to ask a broader question of, to what extent are the fiscal risks we've discussed for 2 days visible in the term premium now? And are there some other things in financial markets that might be a better way to look at that, maybe now, maybe at other times? That strikes me as pretty important. So in terms of the other measures, a lot of market participants think of the term premium as something like the price of duration risk, and duration risk being a key component in what you're trying to do as a fixed income investor. Sometimes a really crude way to look at term premiums would be to look at forward interest rates. Like, for instance, you take a 10-year rate 10 years forward, or a 5-year rate 5 years forward, and you subtract the 2-year rate 2 years forward. Why would you do that? The idea is that the 2-year rate 2 years forward approximates the terminal short rate. Maybe you got to go a little further out. And then the long-term rate is the long-term rate. So in between, you have something near the term premium. So people look at all these things with family resemblances. As Rich mentioned, they do tend to move together. And in the last few years, they've generally moved together up. And that seems important. And that might make someone think that that's related to the fiscal concerns that have become more pronounced in recent years, particularly as issuance of treasuries have reached some pretty impressive figures. And yet, when you look at those longer-term time series of the various term premium estimates, as Rich mentioned, they don't actually have much of a correlation with something like the debt to GDP ratio or more fundamental measures of fiscal health. It's not that clear, except in certain tail scenarios. So, so the term premium now, it's gone up a lot, but it's actually not that far from the average over, say, 25 years. Certainly you get before the 2010s, and the term premium now is not even really in the average of the pre-2010s range yet. So it's not high, in spite of a very ugly fiscal situation. Then, where else might we see some fiscal risk? Well, one way is to decompose real and nominal. And on the real side, right now, one thing a lot of bond market investors are talking about is that real forward rates from the TIPS market are actually pretty elevated right now. So if you're worried about a fiscal crisis in the future that's going to lead to some fiscal inflation, right now you can get a 2.5% forward long-term real yield plus be hedged for that inflation. I'm not trying to sell anyone any mutual funds or anything like that, but that real yield is a lot higher than we were hearing about in the 2010s, when in the low R* period. We're never going to see those high interest rates again. We were told, and now we have long-term forward real yields that are pretty high and pretty interesting. But on the inflation expectation side, despite I think a reasonably fair economist's view that the tail risks of inflation, certainly to the upside and maybe to the downside, have grown for lots of fundamental reasons. The actual break-even implied future inflation path or the inflation swap market future implied inflation path is actually pretty dull. And this is a way, someone like Rich has probably said thousands of times, inflation expectations are well anchored. So we see implied inflation expectation estimates from market-derived indicators that are basically in the mid-twos or even a little bit lower as we go further out. So that term premium we described obviously has a nominal component and a real component. The inflation component is not doing much. The real part is doing much. What does that really tell us? Maybe that's something that we will discuss. Elsewhere in markets, you could look to gold and you can look to crypto, and you could go on Twitter or something and hear the discussions, and there seem certainly to be a place where people are worrying about fiscal trajectory and narratives about fiscal doom are animating trades and investments, but that's the fringe of financial markets. That's not the core. So to say that we are concerned about fiscal, therefore Bitcoin is worth some crazy number, is not really to say that the bond market is incorporating that view. I'd leave you with a more fundamental observation, which is I do think when you look at the history, in fact, in the last presentation we had some nice long-term charts. When you look at history, you see the big shocks, of course, the wars, the pandemics, other things. These are the events where the delivered inflation occurs. It strikes me that a lot of the discussion about fiscal futures kind of gravitate toward equilibrating solutions. What if we had this much in inflation surprise on average over time? What if rates were a little bit lower? What if total factor productivity were a little bit higher? But I think when you look at the history, or you look at CBO projections in the past compared with what actually happened after those projections were made, you find that it's really the big shocks that shape fiscal history and present the real risks that investors and bondholders and the government overall, as it finances itself, actually face. So, it's the wars, it's the pandemics, it's the sudden expensive things that could be a climate shock. I think the important question really is, our initial conditions now of debt to GDP over 100%, of supply chains where there's a lot of goods that we need produced that rely on critical components from abroad, and we have a starting condition of government revenues, of let's say 17% of GDP and government expenditures of 23.5. However we solve the problems implicit in those numbers, the real issue is the fragility of a system that starts off like that, and how unusual those initial conditions would be compared to history, and how we would have done during history had we had those initial conditions when various shocks that did occur arose. We would have done worse. I don't know how, but I think thinking about the distribution of actual inflation shocks in the history, what it means for actual inflation shocks going forward, and what that means for bond investors and the fiscal path is very, very central. But of course, we can't answer those questions. So I'll stop there. I think that's my time, and thank you.
Thank you. So I'm going to try to ask them a few clarifying questions for a few minutes, and then we'll have a three-way conversation, and they can even ask me a question if they feel like it, and then we'll open it up for everyone and hope we have a good conversation. I think I want to both give you an opening to say whatever else you want to say, but also press you a little bit. First, how we label it gives it meaning. So if we call it a term premium, we're calling it something. If we call it a risk premium, we're calling it something else. If we call it an uncertainty premium, we're even opening it up further. And so that's one dimension of the puzzle, like the label you put on it. We're also talking about it as a residual. There's a lot going on here. We think it's not supposed to have inflation in it, but it's supposed to have long-run supply and short-run demand dynamics if the central bank's going to step in. So we got all that stewing on in there. Now, choose your own label. What do you want to label it? And then what do you want to then add to the mix on, is it long-run supply or is it short-run demand? Rich.
Well, I'll cop out and say all of the above, but seriously, when I began to study this as an undergraduate or in graduate school in the 80s, I could Google search it. I don't think it was even being called a term premium. It was either called a risk premium or it was called inflation premium, because you got a 30-year bond in 1979. Who the hell knew what the price level was going to be in 30 years or 3 years? And so I think the first order thing to get right is, are you being compensated because of price level risk or because of either growth or supply risk? And I put that as a question because there would be different interpretations and different models that would be relevant. So we're at a very basic level. I mentioned first have to measure it before you model it, but even there, I think I wouldn't take a stand on either. Or maybe just to get in a point I was going to get in anyway at some point today, and it's very much building off what I heard James just say. The arithmetic of initial conditions is, I think, quite important right now in the following sense. If you've got 100% of GDP of debt, then before the first penny of budget deficit, you're rolling over a lot of stuff every year. So if there's a throughput constraint in the plumbing of the Treasury market, it's much more of a big deal when you're rolling over. My calculation is before the first penny of budget deficit, and depending upon the bill share that Besant focuses on, you're looking at about $4 trillion of coupon rollovers that you're doing before you actually start issuing debt to pay for the deficit. And whatever those numbers are 15 or 20 years ago, I mean, the orders of magnitude larger. So you get an interplay between stock and market technicals that was probably not relevant as well. So, is that a term premium? Is that a plumbing premium? Again, it's all in the residual.
James, you want to jump in there?
Yeah, I mean, I think of the term premium as a key component in the cost of duration risk. And I think of duration risk as a specific thing that a lot of investors want in their portfolios for their needs. I was once on the pension committee of an investment bank, which switched to LDI while I was there, and it's magical. They buy a bunch of 30 years, and all of a sudden you're permanently at 100% funded ratio, roughly. And if you're on a pension committee, you're afraid of getting sued. That's your job. Your job is to not get sued. So if you hear we can make this thing really boring, you make it really boring. Are you hedging the real risks of the pensioners, of their ability to eat, based on the nominal claims they'll be monetizing one day? No. That seems important. But you have this structural need for certain types of securities that fit in certain places. And the other point is that, of course, the slope of issuance by maturity goes down a lot when you get further out. So that structural need is really high. The actual availability of very long-term paper isn't that high. And so supply and demand and market clearing yield and price get shaped by those dynamics much more than by papers about what the debt to GDP ratio is going to be in 10 years.
Maybe if I can just amplify the point, and I should say, even though I've been at PIMCO off and on for 19 years, I've never traded a bond, which is good for PIMCO, but I sit next to people who do, and I think one case study of this, which some or maybe many of you know, is we actually have across countries different regulations for how you manage defined benefit plans. And the UK is an example where when they changed their LDI regime, it definitely began to show up in the yields of very long-dated gilts. And so, is that a technical factor or a risk factor? But it definitely reflected the preferred habitat of that regime.
I want to pose one more question to the two of you, ask you both to respond, and this is of a little bit of a setup. First, we observe a live experiment in France, where we have a government in difficulty. We have a big future supply of debt, looks like it's coming on the market, and it looks like we've had an expansion of the premium that we're talking about. But are we looking at a market's estimate of future supply, or are we looking at the realization by a lot of bond traders that the ECB is not likely to be able to support the French bond market the way they were the Greek bond market or the Spanish bond market? It's just too big. So with that hanging over you, and so we're now talking about a world of post-QE where the market has to ponder the risk the central bank comes in a big way, in a way that I never used to do when I ran the open market desk. We stayed smooth across the curve. We hardly ever bought outright unless we thought it was a permanent expansion of note issuance or something like that. But I am going to tell a little story on myself. In the 1990s, I was an arrogant young man, and I got myself the opportunity to persuade Alan Greenspan to listen to me, explain why he should let me do yield curve control. That the thrust of monetary policy was determined by the slope of the curve. And so why didn't we just control the curve? Because then we'd have an even better thrust of monetary policy. And he very graciously listened to me for some minutes, and then there was a silence. And then he said, "But Peter, then we would be looking at ourselves in the mirror." And I want you to ponder that problem, that we have now a bond market that has adapted to a world in which the Fed seems to have an opinion about the slope of the curve post-QE and moving to different spots on the curve when they buy. And so sort of when we think about this residual premium that we're trying to measure, the thermometer I said, how do we think about how the market thinks about the overhang of prospective central bank behavior?
I'll let you lead off on that.
Well, I think actually there's an element in this discussion that hasn't come up in 2 days, which is what has happened to private sector balance sheets on the way to this high debt. Some of this high debt funded checks to people. And in the normal way, if you look at the savings, the net savings of the private sector versus the net savings of the public sector, in the pandemic, they went like this. And that's not weird. That's to be expected. And the MMT people would say that was the capacity to buy the debt being created by the debt, which isn't totally wrong. I don't think policy prescriptions come out of that observation. But now, a few years later, we have enormously high asset prices in a lot of ways, in terms of house prices or equity market, just ratio to inflation, right, compared to history. And we have huge balances in things like money market funds. Ask yourself, where would those real asset prices be? Where would those money balances be? Where would the debt to GDP be? Where would household net worth be in the absence of those policies that we've had in the last 10 or 15 years? They'd be pretty different. So what's the point of that? The point is that if we're looking at the term premium only from the perspective of like a CBO debt to GDP projection or something like that, and not considering it holistically as part of an economy which also includes a private sector that actually got put in good shape by this, that's a big part of it. So how is this relevant for France? Well, for France, a lot of those good things that have happened on the private side of the balance sheet in the US haven't happened in quite the same way. And that the US recently has some newfound optimism about productivity growth, which is not there in France. So I think there's a relative crisis of confidence compared with the US at this particular moment. But these things come and go, just like the term premium, because if you look at it through history, it sort of moves like the VIX. It spikes, it comes down, it does nothing for a while, even though you think it should, and it spikes again. And I think history will continue to go on like that.
Rich.
A correlated but not perfectly correlated point, which I hope to be responsive to Peter's teeing it up. And again, this is probably something that most or all of you know, but it does get left out in a lot of Twitter and CNBC and Bloomberg discussion. And I used to teach money and banking years ago. I don't do it anymore. But the reality, and anyone who's been in the Fed system lives and breathes this. Operating in a world in which you're paying a market rate of interest on reserves is fundamentally a different way to think about monetary economics, and especially in a world where, because of QE and a pandemic collapse and a financial crisis, global central bank balance sheets expanded. And so essentially the way I like to think about it, and I did a piece in The Economist by invitation 3 years ago to work this out without equations, is that when the Fed is doing QE, it's not really extinguishing any debt or coupon payments. What it's doing is a fixed for floating swap with the Treasury liability. So whatever constellation of fixed coupons were out there, there are fewer of them replaced by reserves that pay a market rate of interest, and in turn, those reserves are backed by the Fed's holdings. And if you basically integrate the income or the balance sheet statements of the Fed with the Treasury, you see that clearly, and Andy Levin and co-authors have done that arithmetic, and you can see how dramatic that effect is. I think one reason why this point is not better understood is that central banks tended to do QE initially when rates were zero, and they were afraid they were going to be zero for a long time. So it was not clear that you were doing a fixed for floating swap. It looked like a fixed for a zero rate swap, i.e., printing $100 bills. But in an equilibrium where obviously there's positive inflation for whatever reason, then that is no longer the case. So I think there are fiscal consequences. They're also important, especially in the post-Dodd-Frank world, and I think Carmen and I have discussed this in the past. We're in a world in which big global banks are required to have a lot of or what are called high-quality liquid assets. And when I joined the Fed, I made a promise to myself. I try to learn something new every day, and it was pretty easy because a lot happened in those 4 years. But one of the things I learned one day is that banks don't think of T-bills and reserves as close to perfect substitutes, because reserves give you instantaneous liquidity, and 5 minutes I can liquidate them, and treasuries typically will settle, plus something. Not plus instantaneously. And so what you see is that big banks want to hold a lot of reserves, but ultimately those reserves are paying a market rate that are backed by the T-bills or the coupons that would have been otherwise in the hands of the public. And I'll finish up with a related point, is if you do the counterfactual, and it's impossible to do rigorously, but just think of a world where the Fed had not done QE either after the 2008 crisis or after the pandemic collapse, but just suppose we had exactly the fiscal policy that we had anyway. The mix of Treasury liabilities would be different between floating and fixed, but it would be the same quantum number, but then all of it would be residing in private sector balance sheet. So think of the SVB episode, but instead of SVB, think of every bank in the U.S. holding that quantum of treasuries that got issued or money market funds. And so I do think that there is something the financial system is still getting accustomed to, which is the first decade or so of QE was the low rate, zero rate, secular stagnation, negative rate world. And we're now really only in year 3 or 4 of a regime of very positive interest rates, and thus positive fiscal cost of the past QE.
One last question from me. I want you each to try out, just think about the bond market, either agree or disagree with the extreme statement that the bond market doesn't really give a damn about supply 30 years from now. That's just too far away. And they just can't, they're not going to think about it. Maybe 10, but even 10 is a long way away. So now you can take either side of that. Should the bond market, does the bond market care? about some supply issue that's that far in the future, given that it's got to deal with the Fed and all this banking system noise.
I guess we're alternating who's going first, so
Yes.
I'll
All
go
right,
first on
yes.
this. I'll give you a version of it, Peter. I think part of what goes on, I don't think France can maybe get away with this, and many other countries in the world, but there are a handful that can. I think part of what goes on is a little bit more basic, which is everyone in the bond market knows what we all know, that the U.S. is on an unsustainable fiscal path. They've all seen these charts. And they just assume at some point Herb Stein will kick in and something that cannot go on forever will stop. And I think if you basically gave folks, bond traders, truth serum, they would say sometime between the year 2031 and 2039 it will happen. And so eventually it will be put on a sustainable path, but it's down the road. So I think that's why in some sense they don't care, because they don't need to know the details. They just know at some point it will be addressed. But maybe that's completely missing the point. James?
Well, I mean, I think, you know, what was Keynes's beauty contest quote, right? Like
Yeah.
You're forecasting what you think the rest of the market is going to do, right? And so if you don't think the rest of the market is going to panic about fiscal concerns and cause the bonds to sell off a lot in the next period or the period after that, your incentive to short the bond now and sit and wait just isn't there. You need the catalyzing event, or you need something allowing sizable investors to actually go in and really move the market themselves. Otherwise, you just wait. And imagine, I mean, you said something yesterday about 20 years ago, talking about the bad, you know, wasn't, you know, if you were short treasuries for the last 20 years, it might not have gone so well most of the time. So I think it's a beauty contest thing.
Well, the other thing I mentioned yesterday is the option I didn't price 25 years ago, which is the option that the U.S. government has to tax the economy at higher rates in the future. That's what the bond market thinks is going to get exercised in the next decade. And it seems like it's always been the next decade for my whole career that it would be exercised. It was exercised in the 1990s. And some of my predecessors at the Treasury are quick to point out that I'm the only debt manager who had a surplus. So I didn't really have a very difficult job as a debt manager, anyway. You want to ask each other questions? You want to ask me a question? I mean, before we open it up, I'm going to give you each a chance with each other.
I have a question for you, and I'm not sure if you shared it in your speech last night, since I was just finishing up teaching my class. But you and I were at Treasury together in '01, as I mentioned. We met in your office on September 11th, and have very vivid recollections of that. But talk about the period in, I guess, October, November of '01, when under your leadership, the Treasury was thinking about the maturity composition of debt and issuance, in particular, starting with a 3, and not the 3-year.
Yes, not the 3-year. Rich wants me to recount my suspending issuance of the 30-year bond, it's a little episode in how clever is the market in pricing supply. Professor Fisher is not awarding a passing grade to this episode. So the prior administration came to run surpluses. They started buying back long-term treasuries, particularly 30-year bonds, and they kept issuing them. And so they were actually buying back more than they were issuing, which I rather thought of as offering the primary dealers a balance sheet vacuum cleaning service to issue on the runs and buy back everything else. And it struck me as a simple thing to do, which my superiors at the Treasury and the White House were fine with, was to suspend both borrowing at the 30-year point and buying back at the long end of the curve, which I did. I actually, one of my motives was I thought, well, if we're running surpluses, I think my estimate then was about 50 basis points, was a pure uncertainty premium, that you're going to get back a lump of principal 30 years hence, and you have no idea what that interest rate environment's going to be. There are lots of other uncertainties along the way, but so the US taxpayer is paying for this lump of uncertainty. But Wall Street was stripping the 30 years and selling the interest-only strip to pensions and insurance companies and trading the vol on the 30-year PO among themselves for fun and profit. And I thought, I don't need to be subsidizing that as long as we're running surpluses. So we suspended the 30-year issuance and the buybacks. The bond market rallied fantastically and dramatically and wrong-headedly on the announcement, not having put together that we were increasing the forward floating supply of 30-year paper. So they rallied on the announcement and then had to collapse the next day when everyone actually read all 50 words of the announcement. I guess a lesson there for me was, no matter how careful I was in making the announcement, it's hard for the bond market to think clearly about stuff, and maybe the positions people were running were more important to them than my announcement. But that is a little experiment we ran in changing the forward supply, and it took the market 36 hours to sort it out. I don't know, was there some other lesson you wanted to?
That's the one I was thinking of. Yeah.
Can I ask him a question?
Yes, you can.
Are we looking at the wrong end of the yield curve in terms of finding the fiscal risks? So what I mean by that is our star should have deficits in it, I think, from a theory perspective. And from a practical perspective, you just said interest on reserves matter. I talked about the size of the money fund balances. We have to have rates sufficiently high at the front end in order to keep that money in money funds. So could the fiscal problems be at the front end of the curve rather than the back end?
Of course, it's one curve. It's general equilibrium. They're all related to the other. In fact, I would put this in the category of an important open question in the following sense, that if you're going to take on, if an investor is going to take on the interest rate risk, roughly the price volatility of a 10-year bond is 10 times a one-year bond. So there is the hedging value in recession and LDI and that, but to the extent there's still a piece of being needing to be compensated for volatility, the question is, how do you deliver to the investor that expected excess return? And there are different ways it can happen. One way it can happen is that most of the time the yield curve is exactly flat, but every 6 years you have a recession, then you get a big rally in the 10-year, and it's a nice hedge against your equity risk, right? And that's a model where most of the time you have a very flat yield curve, but historically what has happened is yield curves have positive slopes, and so part of the return you get is rolling down the curve. And to me, it's an interesting but open question about how in the next 5 years the Treasury market will clear. We know historically, this is a fact, you can look it up on Fred or Bloomberg, but say, what I call sort of the post-Volcker era from '94, when Greenspan showed that he really cared, he didn't want inflation to go from above 2, till to 07, when 08, when rates got to 0 with the GFC and the zero bound hit. In those 15 years, the average slope of the Treasury curve in a low inflation environment, a 2% inflation environment, between the 10-year point and the bill point was about 200 basis points. And so people began to think the curve is normally positively sloped, and that was a source of return on average to holding the longer term bond. It need not be. It could come from other sources, including, as you mentioned, people who buy treasuries to hedge their pension risk, or you get the hedging value in the downturn. But there is an equilibrium where the front end has to be elevated too, as you mentioned, in which case presumably you're holding the treasury because it's going to be that hedge in a downturn.
Terrific. Well, I want to open it up to questions from all of you and even conversation, bringing in all the topics we've had over the last 2 days, because it's all in a microcosm here in a little thermometer. We're trying to measure what's going on. So let me open it up to you for your questions. Please step up to the microphone. So just come on up so we can all hear you at a microphone. Where don't you stand at a mic and that?
Because, Rich, as you were talking, you described the rate on reserves as a market rate, and that got my hackles up, because the rate on reserves is an administrative rate. So when I've looked at that rate and compared it to, say, overnight repo rates or short-term treasury rates, it's actually elevated, which is perhaps good for the treasury market, because while you all were talking, I was thinking what would happen if there was a crisis, like a rollover crisis on the short end. And the fact that it is an administrative rate means that there can be the financial repression we were talking about in the last discussion in real time. So what would happen? The bond markets would say, no, thank you. And the central bank would say, oh, that's okay, because we'll buy it. And then the question is, how does the central bank have enough money to buy it? And the answer is, they can set the interest rate on reserves to get the money they need. And they're assuming there's still some faith that the reserves will be paid that interest rate the same day. So it's another form, actually, of a fiscal bailout of the government of itself. But I think if you want to start saying we're in a whole new world, when we have these large balance sheets, I've actually thought those balance sheets were another kind of a fiscal liability because they're being funded at a non-market rate. So I don't know if that's what you want me to talk about.
Maybe I can just clarify. I agree with everything Debbie said. When I say it's a T-bill rate, I'm saying that the market clearing T-bill rates are close to the administered rates. They're not identical. And I actually think that 25 basis point range is, in my view, quite important. And another issue is whether or not monetary policy should suppress all repo volatility, and I think no. But let me be clear, when I say that the reserves are being funded at a T-bill rate, that was it's not exactly a T-bill rate, but it's.
Importantly, it's above.
Yeah, well, right.
Not exactly.
Right.
Whatever the corresponding
Yeah.
T-bill rate is, it's kind of. That's why, just to try to support that with empirical evidence, only banks have direct access to the reserves, right?
Yeah.
So a lot of companies put their money at the bank to have access to those relatively generous interest rates on reserves from the Fed. And you can argue that premium isn't as high now as it was at the beginning when we were closer to a crisis situation. But nevertheless, it's an attractive place to park money short term because the Fed can engage in what I would call a fiscal policy of subsidizing interest rates on the reserve.
Other questions or comments from you all to us? So, Doug, come to a mic so we can hear you.
Thank you. I wanted to pick up on a comment of yours, James, about the fiscal policy having basically given a lot of money to the private sector, so the government incurred debt and the private sector had the wealth to buy the debt. I think it's a rather similar point made in a paper at Jackson Hole in August by Ludwig Straub. And the analysis he and his co-authors did was that with the aging of the population, that pushes up government spending under current policies, but also pushes up wealth relative to the size of the economy. And so when people like I always draw these charts with debt as a share of GDP, and we show them going up so fast, and well, how could you possibly support that debt on the GDP basis? Another way to think about that, I believe, is to think of the denominator as private sector wealth, and what share of private sector wealth would have to be used to absorb government debt. And if wealth is rising relative to GDP, which it might well do in an aging population, that gives more running room. Now, I would say the particular paper in August I thought gave too much running room, but I'm curious whether you think about it this way and what sense that makes or doesn't make to you.
Yeah, well, I mean, I do look at that, and the wealth to GDP measures are extraordinarily high at the moment, and it's both public and private equity as well as house prices that are creating that. But if you look at something like real house prices, you got to the all-time high in 06, 07, you fell, and now you're higher than the all-time high. You're at a new all-time high, starting to fall, very, very small amount in recent months. So on one hand, you could say, yeah, if we look at debt relative to household wealth, net worth, it's going to be much less alarming, right? A different leverage ratio, basically. At the same time, there's a fragility to wealth. I mean, this is at current market prices, most of this stuff, or it should be. And you could say, are there certain conditions right now that actually have house prices in a disequilibrium? I mean, there are, when you look at ratios of net worth to income across economies over long periods historically, you actually do see a central tendency with the ratio like 5, 6, 7 times. I think Japan in 1989 was the highest you've ever seen. You don't want to be high, because when you're high, it means there's a danger, and we're high now. So I don't know that I would take that as a constructive signal, but from a short-term perspective, most investors absolutely see that as a constructive signal right now, because they say this means household balance sheets are strong and that the economy is fine. And in the short run, they're probably right.
Rich, you want to add to that?
Nothing to add. James said it very well. That sounds right.
Other questions, comments?
Very appreciate. Yeah, I'm Z. I'm from the School of Architecture and Planning. I'm a sports fellow. I do research about the AI, humans, and biases. I'm just wondering how you think about the AI nowadays. I mean, shift the value system and how impact the QE. What the short term, what you discuss is problem. Thank you very much.
I missed some of the question.
Yeah, my question is the AI shift all the world, the value system, include the financial system. So how they could impact the QE now, what we discuss this problem, or we will be find a solution, or will be have another big problem like the unequal right incoming from different, group of people, or that kind of, what do you expect about this? Thank you.
Okay, a couple things on that. I think, and Governor Waller has recently given at least one speech and commented on something which may become important for the next Fed chair. The new Fed is making decisions not only on the size of the balance sheet, but the composition. Those are two separate things. You can have a big balance sheet and a lot of bank reserves, but it's being backed much more with a portfolio that's tilted towards the front end of the yield curve. The Fed. I wasn't there then. Eric wasn't. Maybe Peter was. But the Fed at one point talked about even actually selling treasuries or mortgages. At least so far, they haven't done that. But if you just let the existing portfolio run off and you reinvest at the front end, then over a pretty reasonable period of time, you get a much shorter maturity in the portfolio. And what I would mention, and I'll get back to my sort of gain of function critique from Secretary Bessent, and Peter mentioned the buybacks, right? And so we currently are doing buybacks. The Yellen Treasury was doing them. The treasuries have been doing them for decades. And the interesting thing about buybacks is that they have no debt limit implications, right? Because you just sell bills and then you buy back coupons. And so, conceptually or institutionally, there's not any reason for the Fed to have a particular monopoly over the maturity structure of outstanding treasuries. The Treasury can just do buybacks if they went fewer 30 or 10 years out there. And so you could see a scenario where the Fed makes a decision on the size of its balance sheet, but is very tilted to the front end. that more or less means, subject to Debbie's observation, that the interest that they're earning on the portfolio will closely track what they have to pay on reserves, and then you just let the Treasury do the maturity management through buybacks if they want to. Now, interestingly enough, it does not work the same for the second Besant critique of the Fed holding a big mortgage portfolio. Because if Besant were to issue bills or 2 years to buy mortgages, then obviously that does count against the debt limit. And of course, before the agencies went under, they had very large retained portfolios. In fact, Peter, another vivid recollection of I have working with you, you and I attended a meeting once with, shall we say, senior executives of Fannie Mae and Freddie Mac, and they very much enjoyed that pre-08 regime when they had a $1.5 trillion retained portfolio that they were funding overnight. But I think an important point that people forget, and I wasn't at the Fed in 08 and 09, but I've read the history, is that because the agencies were in conservatorship, that the Fed felt that there was a need for the Fed balance sheet essentially to substitute for what the agencies had been doing. Now, I think a larger point, an important public policy point that may get resolved in the future is, does the U.S. housing market actually require a residual backstop balance sheet? Perhaps it doesn't, in which case nobody needs to be in the market of having a retained mortgage portfolio. But essentially the transition from 08 to the present was in times of stress, both in 08 and in 2020. The Fed stepped into that role. And so if the Fed were to get out of the mortgage business, it would take quite a long time if you do it organically, right, because of the 30-year mortgages and the number of them that repay earlier. And so then you have to start thinking more creatively about how you would want to move away from the status quo.
As a footnote, see if James wants to add more here. Both before and after my conversation with Greenspan, in the 1990s, the Fed's SOMA portfolio held exactly the same percentage all across the yield curve. It was sort of, that's what we did. It was on autopilot. We just had 5 or 6 or whatever percent it was all the way across. And some members of the FOMC were reluctant to want to buy TIPS when they were first issued because it looked like the Fed was buying inflation insurance. And I had to explain that, no, it would be somewhat more awkward if somehow the Fed refused to buy something that the Treasury was issuing. That neither one was a very comfortable spot, but the simpler one was just buy 5% of whatever the Treasury is issuing and hold it all across the curve. James, you want to add anything here?
I think we're well covered.
Another question. Anyone? Questions, comments, insights? Yes, come up to a microphone.
Thank you for the discussion. This is somewhat of a tangential question, but how do you think about the relationship between gold and the term premium? Looking at the incredible rise in gold prices over the past couple of years, are we seeing sort of conflicting signals about the sustainability of future deficits in the two markets, or is it just completely two different risk price in the two markets?
I mean, I haven't calculated the correlation coefficient on that, but I would guess it's positive, but extremely low. Gold has more to it than just inflation concerns, of course. It has its own supply, demand, and special dynamics. And as we mentioned, the term premium itself often is moving for reasons other than fiscal concerns or inflation or things like that. So I think during an acute fiscal narrative crisis, you're likely to see a higher gold price and a higher term premium, but that's not a very frequent event.
Rich, do you want to add something? I'll just say my own experience, I've sort of given up on the gold market, only because when I was at the Fed and the Treasury, there were things one could learn about sources of demand from around the world that like, oh, well, so Russia's buying, or the CIA tells you that, or wealth accumulation in India and China is what really moved it last month, and you'd find that out with a lag. And so I don't mean to dismiss that there are supply concerns and inflation premium in it, but there's just an awful lot that goes into the global commodity called gold. And if you don't know what's going on in that market, you can overinterpret it. That's a little note of caution I'd add. Other questions? Yes.
Well, Peter, since you've mentioned tips, this is probably an easy one for you. What happens next week when there's no BLS report on the Consumer Price Index?
Oh, there's an update there. I have in my phone this morning, they said we are going to get the CPI.
They sent those employees back to work. That's a news item overnight. They don't want to miss that one. Yes.
Thank you. You asked about questions broadly. It seems like a bank license is a really valuable embedded option for someone to buy a nice piece of real estate. Has anyone looked at the market on failed banks that are repurchased? I'm assuming they keep their license even if they go under. And so someone could buy it, become a bank, and have a lot of value in that relationship with the Fed. Maybe I'm making too many assumptions, but do you know of anyone who's ever looked at that real estate market of buying a bank? I guess that's a no, okay.
I think there's always been a franchise value to having a bank license, and part of it's the relationship with the Fed, and part of it's the relationship with the depositors, and part of it's the relationship with the borrowers. And I've never
chartered banks.
Yeah, I mean that's the value of a charter, and there's some scarcity value to charters. So I think I'm sure that's a part of any valuation if you put investment bankers to work on buying an existing bank, whether it's failing or solvent.
And of course, the number of banks has fallen in half in the last 15 years. And I was mentioning teaching money in banking. I think when I taught money in banking in the 1980s, it was like 5 or 6 times bigger. And virtually all of those are mergers. And right, we have very few banks go under. And so essentially, that's how that industry has consolidated. Yeah.
And just to make an obvious point, the Fed access is about the collateral that you have. So if you have a tiny bank with Fed access, it's not really worth very much unless you can grow it.
Well, yes, you want to make a comment, Debbie?
This question has been on my mind even before this conversation started. I noticed that the people in the room who wrote the papers saying the bond markets were crazy have left. I was hoping they would have, but I'm going to kind of represent an academic point of view. I don't know if it's my point of view, but so you have something where you know the present value, let's say we know that the present value of the payments by no means match the price of it. So you believe that in a perfect market, if you will, it would just unravel and people would just stop holding it right away because clearly you have this thing that's misvalued. So at some point, at some point something is going to break. And so I've always wondered, is the reason that the bond market isn't really worried about that breaking because somehow you think, well, it hasn't broken already, so we don't have that automatic unraveling that we have in a perfect academic market, so then it becomes a probabilistic thing. But as the fiscal problem gets worse, as you said, James, the probability that some event triggers an outflow becomes larger. And so I've wondered, is the reason we can't trust the bond market vigilantes, to put it in Peter's words, because the bond market actually thinks they're very smart and that they'll somehow be able to anticipate that we're closer to a bad event? And because a lot of this is probabilistic and we're not really talking about it in those terms. So I just want to know how you think about the bond market, because I think the traders are always in and out. So they're not actually holding things for very long, but there are people who are buying and holding for longer. So why are they willing to expose themselves to the risk that things could?
I mean, I would say you're asking us to formalize Keynes's beauty contest observation. And I mean, maybe there are multiple equilibria in a real world that's not well modeled by those models, in the sense that if people don't believe that other people are going to sell, then they're going to keep investing because they think they're going to get a return in the next period, and maybe it's as simple as that.
Rich? Go.
Well, I think the arithmetic is, I think another way to have an empirical thing you can follow that, for Debbie's point, is if you think the path of least resistance in the U.S. is like in most countries at most times, some version of yield curve control, financial repression, and surprise inflation, then at some point when people start getting worried about that probability of that scenario going up, it's going to show up in the break-evens. And so what's interesting now is real rates have gone up. They're not historically high. They're higher than they have been. They're basically back where they were in the 1990s, early 2000s. So real rates are going up, but break-evens aren't. So at least right now, the bond market's view is that it's not going to be yield curve control, big inflation, repression, equilibrium. But as Cochrane and others, including people in this room, teach us, that itself can be fragile in a model. That's not necessarily anchored. In fact, I think at one point in a different time when inflation had been below 2% for a long time, I commented, do we know that inflation expectations are anchored? And what I said is we don't. We just know that inflation's been low for a long time, but that doesn't necessarily mean that they stay anchored depending on the data. But I think right now you don't see those signals. People talk about the gold market, but you don't see it in the break-evens.
I just as an observation, so the people writing the models say, what are the people in the markets doing? What the people in the markets know these things about the debt, and they say, what are the politicians doing? And we had a meeting not that long ago with a very famous politician, and we said, what are you doing? And he said, what do you mean? What are you doing? Do you think this puts pressure on the politicians to change what they're doing with yields where they are? You're the ones that move the yields around, not us. So everybody's pointing at someone else, but it just feels like this can go on for a while.
Before Jonathan gets what will be the last question, I'm going to give Debbie a very upsetting answer to her question, which is now 30 years out of date. So this is in a different universe, a galaxy far away. I remember I had a very pointed question I wanted to ask all the primary dealers. Every month I got to see them all. And I wanted to ask them that what's their confidence in their pricing of the yield curve? Like how confident are they? And especially the long end I was asking about, but how confident were they? And after listening to 4 weeks of answers, I came to a very troubling conclusion, that it was a minority who understood my question. And the minority gave very thoughtful answers. I mean, really sophisticated, anything, the best you could hope for, and really thoughtful stuff that would pass muster in the economy, in the academy, as well as in the market. The majority thought I was asking whether they knew where the number on the screen was. I'm not kidding. They thought I was asking them, could they find the yield on the 30-year bond on their Reuters screen? And they said, sure, I'm very confident. It's right there. I had a whole new appreciation of what my job was. Anyway, so that's one answer. Jonathan, you get the last question.
I'm going to maybe ask a good final question. It's going to echo Debbie's question, but first I think I'll just set the stage a little bit. So we saw the numbers of debt to GDP that kind of look unusually large. And Doug gave a nice example of things that might move total factor productivity around a little bit, and they were kind of depressingly small, maybe. But there's another thing that looks nothing like the debt to GDP ratio, which is the other really important underlying growth rate, which is population growth, which used to be a big source of erosion of debt to GDP, and is now a source of actually increasing debt to GDP. And that's not just a US problem, that's really a global problem. There aren't a lot of countries that are still above a replacement rate, and those that are have population growth rates that are plummeting, even in the emerging market world. So immigration actually is becoming less and less of an issue and help for us, and if it is, it's a hurt for the rest of the world. So suppose one were really sort of more pessimistic, then the 100% picture is actually much worse because of the population growth half. Suppose you were pessimistic then, and you were concerned about the future, and you noted the fact that shorting the long bond isn't very smart, and yet we're looking for space in the long bond. You guys are in the market. What would be the positions you would be putting on as a pessimist? And where then would we look for these prices? And gold just came up. That seems like an obvious one. Are there other places? What would you look for? Where should we be looking? And i.e., where should you be hedging?
Anyone want to start?
Well, I mean, you could look at the housing market, and you could look at our properties oversupplied or undersupplied relative to the, so you can look at the real disconnect rather than the nominal side. The nominal side is trickier for a lot of reasons. At the moment, seems like there's a little bit of a shortage in housing units relative to our population. So that's not really an answer, I guess. It's just a point.
I don't have any particular wisdom other than I think that the interesting thing about slow-moving demographic trends is that they're publicly known and they're slow-moving, and so they should be a big factor. But in my experience, because they're well-known and slow-moving, people actually don't pay attention to them. So that's probably not what you wanted to hear.
My best answer or thought is related to the comment made earlier by, I think, Rich, both Rich and James, on we've got to understand our initial conditions, and they're maybe really different than we think. And actually, the work I did back at BlackRock just the last few years on global retirement challenge, I started my career actually as an investor, investing in yen, managing U.S. foreign currency reserves in yen in the early 90s. And so we didn't invest very aggressively, the foreign currency reserves, but I watched the Japanese economy and markets evolve over the 1990s, and then I had this epiphany a few years ago that we learned the unemployment rate is useless. With a shrinking demographic, with a shrinking population, the unemployment rate doesn't tell you anything. It has no information content. There's no labor coming in, and there's no jobs coming into the market. And so if you looked at the unemployment rate in the late 90s in Japan, it never moved, and it never told you anything. And yet the economy moved around a little bit. And so I fear that we're going through that now in the United States. That people try to interpret as an odd thing. There's something odd in the labor market. Yeah, there is something odd. The unemployment rate doesn't have any information content. And because the market clears way lower than we're used to thinking about, especially under recent changes. So I think there are all sorts of initial conditions problems. And James and Richie's mentioned some, and I'm mentioning a really elemental one. That's the most important number anyone ever talks about. Now, it used to, of course, be the monetary aggregates on Thursday afternoon instead of the employment report Friday afternoon. That was a regime change. Well, we're going to come to a regime change where the unemployment rate just doesn't tell you much. And I think that's got all sorts of problems for how we think about growth. And that's what Japan has come to and Korea has come to. Growth is entirely productivity. There's no new hours worked. There just aren't any. And so it's all on productivity. And so, the famous Krugman quote that productivity is almost everything. No, it's going to be everything because there isn't anything else going on. And I think that's just the tip of the iceberg for how hard it is to interpret where we are, which I think your excellent question on demographics drives to. All right. We're going to wrap it up there. Thank you all. Thanks, James and Rich, and thank everyone.
I won't take any more of your time, except I need to thank a few people who made this all possible. First of all, Deirdre Wade, who is out helping everyone, I don't know if she's in here now, but you can tell her that I told you that she did a fantastic job organizing everything, and I want to thank her. I want to thank Dana Wade and the Peterson Foundation for sponsoring this conference very generously. I want to thank Nick Motto, who helped us. I know there was other people who were helping. And of course, I want to thank all of you, all the presenters, the discussants, the panelists, and all of you who were listening and asking questions. So I hope to see you again at our next conference next year. Thanks. Goodbye.